The global economy is approaching a turning point after decades of dependence on the US dollar. A silent transformation is unfolding, one led not by politicians but by central banks safeguarding their future. For nearly a century, the US dollar dominated world trade, but mounting debt, geopolitical rivalry, and declining trust are eroding its supremacy faster than many expected. Nations such as China, India, Russia, Turkey, and Brazil are leaning toward alternative systems, seeking independence from dollar-based trade settlement. While politicians debate endlessly, central banks move decisively. Their gold buying has surged to levels unseen since World War II, a signal hiding in plain sight. Gold has no default risk, no political allegiance, and no dependency on another nation's promise. In uncertain times, this ancient metal becomes modern insurance. Massive debt levels, rapid money printing, and growing fiscal deficits weaken trust in the dollar's long-term value, prompting central banks to diversify. Economic sanctions, diplomatic rivalries, and trade wars have convinced many nations that relying on the US dollar exposes them to strategic vulnerability. Financial systems rely on trust, but in an era of cyber threats, asset freezes, and political tension, trust is fading quickly among global institutions. Gold is more than a hedge, it is a strategic weapon. In a global conflict or economic crisis, gold-backed reserves give nations negotiation power. The world is quietly preparing for a new financial order. Central banks aren't predicting the currency reset, they are preparing for it. For centuries, gold underpinned global economies. Even after the gold standard was abandoned, central banks maintained reserves as a pillar of financial security. Between 2018 and 2023, central banks purchased over 3,000 tons of gold, the largest accumulation since 1950, signaling preparation for an uncertain monetary future. Russia and China, wary of dollar dependency, have aggressively increased their reserves. Their strategy is designed to reduce vulnerability to US sanctions and dollar fluctuations. Central bankers operate in secrecy and long-term thinking. Unlike traders, they anticipate decades ahead, preparing for crises others cannot foresee. Diversifying reserves into gold reduces systemic risk. By limiting exposure to the dollar, central banks protect their economies from shocks in the global financial system. Central banks also engage in currency swaps to stabilize their reserves. Gold-backed swaps are emerging as a tool to strengthen bilateral trade without relying on the dollar. Timing is everything. Central banks often increase gold purchases before economic instability hits, ensuring they remain insulated from sudden currency devaluation. As major banks accumulate gold, smaller nations follow suit. This domino effect accelerates the shift toward gold-backed security and a potential reset in global finance. Even with the rise of digital currencies, gold remains irreplaceable. Cryptocurrencies are speculative, whereas gold is tangible, universally trusted, and inflation-resistant. Every gold purchase today is a step toward shaping tomorrow's monetary system. Central banks quietly lay the foundation for a more secure gold-backed future. A currency reset is a recalibration of a nation's monetary system. It restores balance in the face of unsustainable debt, devalued currency, and global financial instability. From post-World War to Europe to the 2008 financial crisis, history shows how currency resets have reshaped economies, often quietly before public awareness. Excessive printing of money, runaway debt, currency devaluation, and massive gold accumulation by central banks all signal that a reset may be imminent. Central banks are not passive observers. They orchestrate resets through interest rate adjustments, asset purchases, and strategic gold acquisitions to maintain stability. The US dollar, while dominant, is vulnerable due to massive national debt, trade deficits, and global reliance on its stability, making a reset unavoidable in a crisis scenario. Gold acts as a stabilizing anchor during a currency reset. By backing reserves with gold, nations secure purchasing power and global credibility. A currency reset realigns trade relationships. Countries may favor gold-backed settlements over dollar-based transactions, altering global commerce patterns. Resets impact national economies differently. Exporters, importers, and debt-laden nations experience sudden shifts in trade balance and purchasing power. Market reactions to resets are often volatile. Stock markets, currencies, and commodities respond quickly, while public awareness trails behind central bank actions. A currency reset is both a risk and an opportunity. Nations and investors that anticipate these changes and diversify with gold are better positioned for long-term stability. A currency reset doesn't just affect money, it shifts economic influence. Nations that diversify reserves into gold gain leverage, challenging long-established financial hierarchies. Emerging economies like China, India, and Brazil are using gold-backed strategies to strengthen their global position, creating a new multipolar financial world. The dollar's dominance is waning as nations diversify reserves. Reduced dependency erodes its ability to unilaterally influence global markets and politics. Trade agreements evolve when currencies shift. Countries may prefer gold-backed or local currency trade, minimizing exposure to dollar volatility. Currency resets often trigger debt restructuring. Nations with gold-backed reserves enjoy stronger negotiating positions, while indebted nations face tougher terms. Shifts in currency valuation affect inflation and deflation globally. Gold-backed reserves act as a stabilizing anchor during turbulent market conditions. Investors anticipate resets by reallocating assets into gold, commodities, and safe haven currencies. Stock markets often reflect this transition before public awareness catches up. Currency resets influence geopolitics. Nations with strong gold reserves gain strategic leverage, while dollar-aligned countries must reconsider alliances and trade dependencies. While central banks prepare citizens face real-world consequences, currency resets can magnify economic inequality if governments fail to manage transitions responsibly. The coming currency reset signals a shift toward a multipolar monetary world, where gold-backed strategies determine global influence, trade, and economic stability. Investors are not passive observers. They must understand central bank movements, global trends, and gold accumulation patterns to safeguard and grow wealth. During a currency reset, diversification becomes crucial. Investors should balance gold, currencies, stocks, and commodities to minimize exposure to volatility. Gold remains the most reliable asset during monetary uncertainty. Its intrinsic value and global acceptance make it a cornerstone of protective investment strategies. Investors may hedge against dollar depreciation using foreign currencies or gold-backed instruments, reducing risk in an unstable financial environment. Speculative assets like cryptocurrencies and volatile stocks carry higher risks during a reset. Knowledge, timing, and diversification determine the difference between profit and loss. Central banks rarely announce strategy directly. Investors must interpret patterns in gold purchases, interest rate changes, and reserve diversification to anticipate shifts. Currency resets reward foresight. Long-term investors who align with central bank movements and diversify into tangible assets like gold preserve wealth through uncertainty. Emerging markets often benefit from shifts in monetary power. Investors strategically positioned can capitalize on growth before resets ripple globally. Global debt is a critical indicator. High-debt nations may face currency devaluation, while nations with gold-backed reserves remain stable, guiding investor decisions. The coming currency reset is a turning point. Investors who understand, anticipate, and adapt will not only protect wealth but thrive in a transformed financial world. The coming currency reset signals a fundamental shift. Money will no longer be defined solely by national debt or fiat promises, but increasingly by tangible assets and global trust. Gold is set to reclaim its role as a stabilizing anchor. Nations embracing gold-backed reserves position themselves to mitigate volatility and assert influence in global markets. Fiat currencies, especially the dollar, may no longer unilaterally dictate global trade. The reliance on paper promises faces structural challenges from alternative reserves. Digital systems and blockchain can complement traditional assets. Central banks may integrate digital currencies with gold reserves for faster, transparent settlements. Trade will increasingly favor nations with robust gold-backed reserves. Dollar dependency may decrease as bilateral agreements adopt alternative systems. Debt-laden nations face higher scrutiny. Gold-backed economies gain negotiating power, creating a more balanced multipolar financial order. Savvy investors recognize shifts early. Diversification, gold allocation, and strategic exposure to emerging markets become essential in navigating the evolving monetary landscape. Despite preparation, uncertainties remain. Market volatility, geopolitical tensions, and unpredictable crises can accelerate or reshape the currency reset trajectory. A new financial order encourages collaboration. Gold-backed and diversified reserves can foster stability, reduce conflict, and enhance global trust in economic systems. The currency reset is not merely a challenge, it's a turning point. By embracing stability, foresight, and tangible assets like gold, nations and investors can thrive in the next era of global finance.